It's now breaking out, meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, it's helped gold go up. But when you break that spread out, and you're doing it this month, we're at levels now that are credibly above that breakout point. It says, hey, it's just beginning. It's been too low, too contained for too long, and when it finally unleashes, what happens in those type of events is when the market has created a false reality, fooled people into thinking that's where it deserves to be, and when it wakes up, it not only goes to a new reality, but it often overshoots it, and it doesn't take years to get there.
In today's news recap, gold heads for fourth monthly gain, silver hits fresh record high, spot gold rose 1% to a 2-week high on Friday as expectations that the Federal Reserve will trim interest rates next month lifted demand for the non-yielding asset, while silver hit a fresh record high. Spot gold rose to $4,192.78 per ounce, its highest since November 14th, and was set for a 2.9% weekly gain. Bullion, set to register a 4.6% rise this month, is on track for its fourth consecutive monthly gain. Silver climbed to a fresh record high of $55.33 per ounce, up 3.5% for the session and 13% for the month. The expectation is that we're going to continue to have a slower economy going into 2026, and the Federal Reserve is very likely to cut rates, which is getting some investors back into gold, said Bart Mellick, head of commodity strategies at TD Securities. What do you think, you guys? Are gold and silver set to soar in 2026? Gold tends to do well in low interest rate environments. Recent dovish remarks from Fed Governor Christopher Waller and New York Fed President John Williams, combined with softer U.S. economic data following the government shutdown, have strengthened expectations that the central bank will cut interest rates next month. Traders see an 89% chance of a rate cut in December, up from 50% last week. Meanwhile, the technical charts for silver have turned more bullish in the past week or so, and that's inviting the chart-based speculators to the long side of the silver market, said Jim Wyckoff, senior analyst at Kitco Metals. Gold demand was subdued across major Asian markets this week as high prices curbed retail buying even as India entered its wedding season. In China, the removal of a tax exemption on gold purchases dented consumer appetite. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Charts that we're looking at, neither one of them are simple price charts, which everybody is deluded by one way or the other. That's why there's a chorus of folks still calling every time the gold flinches, it's got to correct, et cetera, or it's the top. There is a relationship between gold and the S&P 500 or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent. And we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P. And during its bear market, 2011 through, especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply. Now, when you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base. Meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you were just looking at that chart, and I erased the words gold versus S&P and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. And that's because they're focused on what? A simplistic price chart. And when you run a relative performance chart, it's saying not only has money been moving into gold since 2024 soundly, solidly, it's now breaking out. Meaning that the money flow that we've seen coming out of doubters in the stock market, some large skeptical asset managers, let's assume, who've said, hey, I need a little bit more in that monetary metal sector. Okay, and they've been, a little bit here and there. It's helped gold go up. But when you break that spread out, and you're doing it this month, we're at levels now that are credibly above that breakout point. It says, hey, it's just beginning. This relative performance asset shift out of the stock market into monetary metals is only now beginning. So those folks who've been tell you that, oh, this has gone too far, too long, et cetera, they need to look at that chart because it says something totally different.
In today's news recap, silver hits fresh record after topping peak from October squeeze. Silver jumped to a record, surpassing a peak set during a historic squeeze in the London market in October. Spot prices surged as much as 4.2% to about $55.66 an ounce. The white metal has been supported by rising hopes of a Federal Reserve interest rate cut in December, inflows into bullion-backed exchange-traded funds, and ongoing supply tightness. Friday also saw erratic price moves and thin liquidity in the silver market after a chaotic hours-long halt to trading in futures on the CME's Comex exchange. By early morning U.S. time, most trading operations were back. Silver's new high comes just over a month after a severe supply squeeze in the dominant silver trading hub in London last month, which sent prices soaring above levels in Shanghai and New York. While the arrival of nearly 54 million troy ounces has eased that squeeze, the market still remains markedly tight, with the cost of borrowing the metal over 1 month hovering above its normal level. The flows into the London market have now put pressure on other hubs, including in China. Silver inventories in warehouses linked to the Shanghai Futures Exchange recently hit their lowest level since 2015, according to Bourse data. In the short term, a further price increase cannot be ruled out if registered silver inventories in China continue to decline, analysts at Commerzbank AG wrote in a note earlier Friday. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
There's another chart we can talk about if you want to, unless you want me to pause a bit here. If you plot silver versus gold spread chart also, where you don't look at the price of silver, you don't look at the price of gold. Instead, what you do is you divide the futures contract December silver right now into the price of December gold, and you express the answer of that as a percent. You'll see that we've developed a spread chart basing action, much like that gold versus S&P basing action, where, silver's had a surge back in 2020. You recall that move where silver went from like $15 to 30 and gold only went up about 40%. Well, silver outperformed up through late 2020. And then we went into that multi-year period where, gold went sideways through early 2024. And silver and the miners actually sort of declined in relative performance. No, they were going up. There was a rise, net rise there, but they were underperforming gold, the mono metal. Silver has been surging versus gold since early this year, about April. It's really come up sharply on a relative basis, so it's been a better place to be, net on balance for the year. But you're challenging now a massive spread breakout base, where not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now, since October. So we've had 2 months of, they sell it, they drop it down, goes back up. They sell it again, drops back down, goes back up. And now for the third time, we're pressing up into the lower 50s. We're $53 now. By the way, we'll rotate our analysis now to March silver starting the 1st of December, when December silver goes into delivery. Also, we'll be shifting out of December gold and shifting to February 2026 contract. And already, when you look at the March silver, it's up to 53.5 area, meaning it's almost ready to touch top tick again, which is 54 in that recent rally on a $1 scale. But that's not the issue to us. The issue to us is that relative performance breakout, gold, S&P, and secondarily, silver says, okay, yeah, the monetary metals are going to go up, but this time I'm not going to be behind you. I'm going to lead. And I think the same applies to investors who don't want to necessarily buy silver futures or calls on silver ETFs, bullion ETFs, or buy silver bullion. They want to buy miners. They want to buy stocks. We technically analyzed that highly, highly likely that not just in the immediate surge we're about to see, and remind me to get back on that subject again in the next 6 months, but over the next year or so, the miners will be gold as well, especially the silver miners relative to the gold miners. So when I speak personally, and I show my position in every report as a disclaimer, I'm heavily into silver related. Calls on SLV, double long AGQ, which is a bullion ETF, but also silver miners. And I'm buying a lot of junior miners now, silver miners, because I think they could be hotter than silver, much hotter. They're extremely neglected. It's a very tiny little sector. And when the hands come in to buy it, money fleeing the stock market or deciding it's a better place to be, monetary metals, those little miners just go vertical. I've seen a lot of days lately where silver's up 2% and they're up 5%. Okay, so I think that's what's going on. But as far as silver, it's in a fairly unique situation, has really partly to do with this broader view of monetary metals going up. But think about this for a minute. Silver's been stuck in a range, $50 highs in 1980, 2011, and even recently either side of 50, for 50 years. What's going on here? I can go show you a chart of copper. Go back to the 70s, 1980s, 1990s, into 2000. And in 2007, after multiple decades of horizontal reality for copper, it broke out, and within a couple quarters, it quadrupled in price. It's late 2005, 2006. And yeah, there was a sharp sell-off after that, but you then, hence, after that surge, a quadrupling in price, you lived in a multi-decade range that is like 3 to 4 times the average price of what prevailed the 70s, 80s, 90s, 2000 for copper. Same is true for lead. Very exciting metal, right? It lived in a multi-decade range, and in 2007, not in sync with copper, a year and a half later, it quadrupled in price in a couple quarters, and since then has lived in a range that's roughly 4 times the price average of that prior multi-decade range. Why is silver still stuck in its 50-year range? Well, there's fundamental arguments for that. Manipulation, attempt to control by some major banks, no doubt with the nod of a head from the Fed and so forth. But when a market makes a mistake, like we've seen stock market bubble tops, and that's when a stock market makes a mistake of, let's say, going too high for too long. Even though the truth underlying the bubble is valid, it's overdone it, like the dot-com high. And so when it corrected, quote, corrected, S&P back then dropped 50% by 2002, but NASDAQ 100 collapsed 82%, despite the truth of the reality of internet changing our lives. It was excessive for too long. Silver, we argue, has been in the same position, except on the downside.
What do you think of his take? Do you agree with him? Is a major melt up in gold and silver going to happen in 2026? Are you buying more gold and silver in Black Friday? Share with the stackers your strategy in the comments section down below, and watch this video right here because it's a perfect fit for you. I'll see you on the other side.